The $2 trillion illusion. How New York City became the world's most expensive lie. What if the most famous city on Earth was never meant to be real? What if the glass towers, billion-dollar condos, and luxury skylines weren't signs of prosperity, but symptoms of a $2 trillion illusion? New York City, the capital of the world, home to Wall Street, dreams, and debt. But behind the bright lights lies a truth no tourist brochure will ever tell you. New York stopped being a city decades ago. Today, it's a financial product, a hyper-engineered illusion built on borrowed money, foreign laundering, and algorithmic speculation. And while the average New Yorker can't afford rent, the city's skyline keeps growing, for investors who never even set foot in it. Because New York's real business isn't real estate, it is the trade of illusion itself. Where are you watching from? Comment your city below. And if you want the unfiltered truth behind modern finance, hit subscribe. Because what you're about to hear then is the real story of how New York became the most expensive lie ever sold. Once upon a time, New York was built on sweat, not speculation. Immigrants, dock workers, factory laborers, the city's value came from what it produced. Steel, textiles, ships, innovation. But by the late 1970s, everything changed. Factories left. Finance moved in. And the new product of New York was money itself. The city teetered on bankruptcy in 1975, but was rescued by Wall Street. That bailout didn't just save the city, it privatized it. A new era was born. Debt became the foundation. Banks realized they could securitize everything, mortgages, rents, even city bonds, and sell them as investments. Neighborhoods became portfolios. Communities became data points. By the 1990s, foreign capital flooded in. Russian oligarchs, Saudi princes, and Chinese conglomerates started buying entire buildings in Manhattan, not to live in them, but to store wealth. Empty penthouses became safety deposit boxes in the sky. Sound familiar? The same trick that inflated housing markets in London, Hong Kong, and Dubai all started right here. New York became the test lab for a global experiment. How much illusion can one city hold before it collapses under its own price tag? By 2010, a new kind of investor arrived, one that never sleeps, never visits, and never cares. Not people, algorithms. High-frequency trading firms and private equity funds began buying real estate like they trade stocks, using derivatives, swaps, and complex credit bundles. Entire skyscrapers became collateral in multi-billion-dollar loans called commercial mortgage-backed securities. These weren't about homes, they were about bets, layers upon layers of synthetic value. By 2022, analysts estimated that over $1.6 trillion in U.S. urban real estate debt was packaged and sold globally, with New York as the largest node. A city turned into a spreadsheet. But here is the part no one mentions. The biggest player in this game wasn't a tier bank or even a billionaire. It was an entity hidden behind shell companies and sovereign wealth. And you won't believe the name, because the true owner of New York's skyline isn't who you think. Stay with me. The receipt is wilder than you think. Let's break down how the illusion works. Step 1. Financialization. When a developer wants to build a $500 million tower, they rarely use their own money. Instead, they take out loans, which banks then slice into smaller pieces, repackage, and sell to investors worldwide. That $500 million project might spawn dozens of synthetic products. Credit default swaps, structured notes, even derivatives linked to rental yields, meaning the same building can be sold 20 times before it even opens. Step 2. Valuation inflation. Appraisers and rating agencies mark these properties to model, meaning they assign value based on prediction, not reality. If you think a building will rent for $10 million a year, it is worth $200 million on paper. Step 3. Liquidity illusion. Investors buy these securities thinking they're backed by real assets. But in truth, most of the value is derived from contracts, not cash flow. It's Enron in slow motion, but on a citywide scale. And who fuels this? Shadow banks. Private funds that aren't regulated like normal banks. They inject liquidity into the market through repurchase agreements, short-term loans collateralized by real estate debt. In plain English, they're betting on bets made from borrowed money backed by buildings nobody lives in. In 2023, over 45% of Manhattan luxury condos were sitting empty, while homelessness hit record highs. A city of ghosts, owned by algorithms. And when the market dips, like during COVID, those same funds don't lose money. They just restructure the debt, inflate the valuations again, and start over. It's a cycle built on moral hazard, because when every dollar is a derivative, collapse isn't failure, it's profit. The illusion keeps growing. As of this year, the total estimated notional exposure tied to New York real estate exceeds $2 trillion. That's larger than the GDP of Italy, based on towers full of nothing. Sound familiar? It's the same model that caused the 2008 crash, except now it's institutionalized. Back then, they said, too big to fail. Now, it's too unreal to question. And at the top of this pyramid? Global asset managers, the BlackRocks, the Vanguards, the invisible hands that own shares of everything, from the banks that issue the loans to the companies that build the towers. In other words, New York is the world's most expensive illusion because it has been sold to everyone yet owned by no one. Every empire in history leaves behind monuments. Rome had its colosseums. New York has its glass towers, empty, overpriced, and quietly crumbling. The next financial collapse won't start with a bank run. It'll start with a vacancy report. When debt stops rolling, the illusion stops breathing. And when that happens, the city that never sleeps finally wakes up. Because New York isn't just a place anymore. It's a reflection of us. Our obsession with appearance over reality. Our willingness to believe in numbers that never existed. They sold us the dream of ownership. But what we really bought was participation in a debt machine that feeds itself. So the question isn't if it breaks, it's when. Share this with someone who still believes property equals prosperity. Subscribe if you want the truth no economist will say on TV. Because in the end, one question remains. Are we wiser now, or just walking the same path in better suits?